Are you riding the greatest wave of wealth generation in history, or are you standing on the edge of the most expensive stock market peak ever recorded?
Oh, man. That is the trillion-dollar question right now.
It really is. It's a question that seems to be basically dividing the entire financial world down the middle right now.
Yeah, I mean, it's the ultimate financial tightrope walk,
Yeah.
you know, because on one side of the ledger, we have these undeniable, just world-changing technological leaps happening in real time.
Right.
But then on the other side, we have valuation metrics flashing these massive warning signs that we simply haven't seen in decades. So finding your footing between those two realities is becoming incredibly difficult.
And that is exactly our mission for today's deep dive. We are navigating the current extremes of the stock market, exploring the booming artificial intelligence sector, and, unpacking the historical warning signs of a market correction. Our goal is to help you, the listener, filter out the conflicting financial noise, understand the underlying mechanics of what is actually happening, and, most importantly, protect your wealth.
Yeah, and to build that framework, we're pulling from a really fascinating stack of sources today. We're going to be analyzing a rigorous Bank of Canada working paper on predicting stock crashes, which is pretty dense but super revealing.
It really is.
We're also diving into modern market analyses regarding the AI sector, reviewing some historical crash frameworks, and breaking down guides on a concept known as market mean reversion.
But before we jump into all those sources, we definitely need to make something perfectly clear. Disclaimer. This is not investment advice. Always do your own research and consult qualified financial advisors before investing.
Very important.
Right, because our goal here on the Wealthnetic Show is strictly education, giving you the tools to think critically about the landscape yourself.
Exactly. Because to understand where the market might be heading tomorrow, we first have to measure the mechanics of where it is today. And that really begins with looking at how far current valuations have stretched away from their historical baselines.
Okay, let's unpack this, starting with this central idea of mean reversion. Because for anyone who hasn't spent their weekend poring over financial research.
Which is most people, thankfully.
Right, yeah. Mean reversion is basically the mathematical tendency for assets, whether that's a single stock or an entire index, to eventually return to their long-term historical average after experiencing a short-term spike or, a massive dip.
Yeah, it acts like the gravitational pull of finance. And that Bank of Canada working paper we reviewed, it focuses heavily on this exact phenomenon.
Right.
The researchers wanted to determine if they could actually predict severe downside risks, meaning, crashes, by measuring the distance between current stock prices and their fundamental realities.
See, I always struggle with that phrase, fundamental reality, because corporate earnings change every single year. I mean, if a company invents a brilliant new product and has one freakishly profitable year, their stock price obviously shoots up.
Oh, absolutely.
So that increase might look perfectly justified in the short term. How do the researchers actually separate a temporary spike from a permanent real shift?
Well, that is the core challenge right there.
Yeah.
To solve it, the researchers created something they call a counterfactual valuation benchmark.
A counterfactual valuation benchmark. Try saying that 3 times fast.
Right. It's a mouthful. But basically, they didn't just look at a single year volatile earnings. Instead, they focused on the cointegration of stock prices and smooth 10-year earnings.
Okay, let me stop you there, because cointegration is a term that usually puts people right to sleep. Let's try to ground that a bit.
Go for it.
If I understand the math correctly, cointegration is kind of like walking a dog on a retractable leash. So the dog is the stock price, darting left and right, running ahead, falling behind.
Yeah.
But you, the person walking the dog, represent the long-term, smoothed-out corporate earnings. So the dog can wander, but eventually the tension on the leash forces the dog back to your path. Is that right?
That is an excellent way to visualize it. Cointegration just means that while two things might wander randomly in the short term, they are fundamentally linked in the long term.
Got it.
So by smoothing out 10 years of earnings, the researchers figured out the path the human is walking. That creates a baseline of what the market should be valued at through a full economic cycle, completely ignoring the temporary manic booms and panic busts.
So when the dog runs too far ahead, the leash gets tight.
Exactly.
Yeah.
And their model shows that when actual stock prices detach significantly from this through-the-cycle fundamental baseline, when that leash is stretched to its absolute limit, the risk of a 25% market crash just skyrockets.
Wow, 25%.
Yeah, and get this, when they back-tested this specific model, it indicated a 71% probability of a crash right before the dot-com bubble burst in late 1999.
A 71% probability is massive. But let me challenge this model for a second here. If mean reversion is about a leash snapping the dog back to the owner, what happens if the economy undergoes a permanent structural shift?
What do you mean?
Like, what if the owner doesn't just keep walking, but gets into a car and starts driving? I mean, if artificial intelligence fundamentally changes how every business on Earth operates and generates profit, doesn't the old baseline just become completely obsolete?
You are hitting on the literal trillion-dollar debate currently happening on Wall Street right now. And to be fair, the Bank of Canada paper does acknowledge this limitation.
Okay, so they do address it.
Yeah. If a true structural shift occurs, like the mass adoption of the internet in the 90s or potentially AI today, the mean itself changes. The baseline moves permanently higher.
Right.
The real danger for investors is that timing a reversion is incredibly difficult because you never know for sure if you're looking at a dangerous bubble or just the market adjusting to a brand new, highly productive era.
And that structural shift debate is the exact tension we are seeing today. Because when we look at the historical metrics in our sources, the tension on that leash is severe.
Oh, the leash is definitely taut. I mean, our sources highlight two glaring metrics that illustrate this perfectly. The first is the market cap to GDP indicator.
Also known as the Buffett indicator, right?
Exactly. It simply compares the total value of the entire stock market to the total economic output of the whole country. And a veteran investor famously noted that anytime this ratio approaches 200%, the market is essentially pricing in decades of perfect, uninterrupted economic growth.
Which is playing with fire. And today, that ratio is sitting at 235%.
Yeah, 235.
So the stock market is valued at more than double the size of the underlying economy. The math on that requires absolute perfection from corporate America for years to come just to justify the price tags.
It's staggering. And the second metric paints a very similar picture, which is the Shiller-Kaipi ratio.
Right. We see that one cited a lot.
Yeah, and similar to the Bank of Canada's dog and leash approach, this ratio compares current stock prices to 10-year inflation-adjusted earnings. According to the data in our sources, it is currently nearing 40.
Which is crazy high.
To put that number into historical context, that is the second highest point in the history of the stock market.
Wow.
The only time it ever went higher was at the absolute peak of the dot-com bubble when it hit 44.
So by almost every historical standard, we are operating in very thin air right now. But these valuations don't just happen in a vacuum. There is always a catalyst, a compelling narrative that the market falls in love with to justify paying these premiums.
Yep.
And today, that narrative is artificial intelligence. The capital flowing into this space is just staggering. Global AI spending is projected to surpass 1.6 trillion USD.
Trillion, with a T.
Yeah, and analysts estimate that the debt used strictly to fund AI data centers could exceed 1 trillion USD by 2028.
The sheer volume of capital is incredible, but what's fascinating here is how that money is actually flowing through the ecosystem. Some market analysts are raising major red flags about a phenomenon known as the circular investment loop.
Yes, the circular loop was honestly one of the most eye-opening concepts in our research. Let's really break down the actual mechanics of how this works.
Okay, let's use a hypothetical example. Imagine a major multi-trillion-dollar tech giant. We'll just call them Company A.
Okay, Company A.
Company A decides to invest $2 billion into a hot, newly formed AI startup, which we'll call Company B. So now Company B has a massive war chest of cash. But to build their advanced AI models, Company B requires an enormous amount of specialized hardware, microchips, and cloud computing power.
And because Company A is a tech giant that owns massive cloud computing infrastructure, Company B takes that $2 billion and uses it to buy their cloud services directly from Company A.
Exactly. That is the loop. Company A's initial investment flows directly back into its own revenue stream.
Wow.
This circular flow artificially inflates the quarterly revenues and profit margins of the major tech giants. It makes their core businesses look like they are experiencing organic, astronomical growth from outside customer demand.
When in reality, they are basically funding their own customers.
Yeah.
That interconnectedness creates a serious vulnerability. I mean, if the venture capital funding ever dries up and the startups stop buying the hardware and cloud space, the big tech companies see a massive drop in revenue,
Right.
which drops their stock price, which in turn hurts their ability to fund the next wave of startups. It's a house of cards.
It creates a huge domino effect. And that fragility is what makes some researchers fear a sudden cascading flash crash. However, in the spirit of impartiality, we have to mention that our sources also provide a very robust counterargument from major financial institutions who reject the bubble narrative entirely.
Yeah, the pushback is important to cover because the current environment really is structurally different from the late 90s. Back then, companies with literally zero revenue were going public and reaching billion-dollar valuations simply by adding .com to their name.
Oh, exactly. Analysts point out that today's technology leaders are generating actual massive enterprise revenue. The median cash flow and capital reserves of the top 500 U.S. firms are currently about 3 times higher than they were during past bubble periods.
Which is a huge difference.
It is. The opposing view argues that, yes, the valuations are historically high, but they are backed by unprecedented, very real profit margins. These companies aren't selling hypothetical web traffic, they are building the digital infrastructure that the entire global economy relies on.
Here's where it gets really interesting, though, because even if a technology succeeds in completely changing the world, that does not mean its stock price is immune to gravity.
Nope.
There is a specific parallel drawn by a veteran investor in our sources that perfectly illustrates this dynamic.
You were referring to the e-commerce survivor from the early 2000s.
Exactly. Think back to the height of the dot-com boom. There was a rising e-commerce company that promised to change how the entire world shopped, bought books, consumed goods, and their thesis was 100% correct.
They were totally right.
They completely revolutionized global retail and logistics, but following the burst of the dot-com bubble, their stock plummeted 92%.
And just to be clear, a 92% drop means an early investor essentially lost their entire principal.
Entirely wiped out. Now, the company eventually recovered, grew into a global juggernaut, and made massive fortunes for the investors who bought in after the crash. But the early investors, the ones who bought at the peak of the hype just because they believed in the technology, they were destroyed.
Yeah.
The investor in our sources compares that historical event to what we are seeing today with a private space exploration company that recently reached a $2 trillion valuation.
Right. And that $2 trillion figure is driven heavily by enthusiasm, imagination, and assumptions about total future dominance in space, rather than current fundamental earnings.
So the takeaway for you, the listener, is crucial here. A technology can absolutely change the world, but if its stock is wildly overvalued, it can still crash spectacularly first. Being right about the technology does not mean you will be right about the investment timing.
Such an important distinction. And if we connect this to the bigger picture, when we zoom out from individual stocks and look at the macroeconomic view, it helps to understand the anatomy of how systemic crashes actually unfold.
Yeah, let's get into the crash anatomy.
A financial analysis in our sources breaks down every major financial collapse of the last century, including 1929, 1987, the dot-com bust, and 2008. The researchers found that despite different catalysts, they all follow a pretty predictable 5-stage sequence.
And the argument being made is that we are actively progressing through these stages right now. So stage 1 is the credit explosion.
Yeah. Every systemic crash begins with an overabundance of debt. When credit grows faster than the real economy, borrowing basically fuels asset purchases. Today, we are seeing record-high corporate debt hovering over 10 trillion USD, alongside massive amounts of margin lending.
Let's quickly explain the mechanics of margin lending because it really is the engine of a crash.
Oh, absolutely.
Margin lending is when you use your existing stock portfolio as collateral to borrow cash from your broker to buy even more stock. So if you have $10,000, you borrow another $10,000 and buy $20,000 worth of shares.
Sounds great on the way up.
Right. When the market goes up, your profits are doubled. But if the stock price drops significantly, your broker issues a margin call. They demand you deposit more cash immediately. If you don't have it, the broker forcefully sells your shares to cover the loan.
And that forced selling pushes the stock price down even further, which triggers more margin calls for other investors, leading to a cascade of forced selling. Which brings us to stage 2, the concentration trap.
The concentration trap.
This occurs when a remarkably small group of assets makes up an outsized share of the overall market's value.
We see this acutely today with passive index investing. Millions of people put part of their paycheck into an S&P 500 index fund every 2 weeks. assuming they're buying a perfectly diversified basket of 500 different companies.
That's a marketing anyway.
Right. But because the index is weighted by market capitalization, roughly 30 to 35% of every dollar goes into just 5 to 7 massive tech companies.
Yeah.
The trap is that buying the broader market now means placing a highly leveraged, concentrated bet on a very small sector.
Yeah.
If just one of those mega cap companies stumbles, it drags the entire index down with it.
Which logically flows into stage 3,
Yeah.
the smart money exit. This is a really fascinating behavioral pattern. Before the 1929 crash, wealthy money managers quietly shifted their holdings to cash. In 2007, a select group of hedge funds quietly shorted the mortgage market. And today, data shows corporate insiders, executives and board members, they're selling off their personal shares at historic rates, while everyday retail investors just continue to buy in.
The mechanism behind this is just simple information asymmetry. Corporate executives see the real-time data. They see the slowing sales, the tightening margins, and the supply chain bottlenecks months before retail investors read about it in a quarterly earnings report.
Exactly.
They quietly head for the exits while the band is still playing. That leads to stage 4, the liquidity illusion.
Liquidity is basically the grease in the gears of the financial system. For years, central banks pumped cash into the system, keeping those gears turning really smoothly. But recently, central banks have been fighting inflation by tightening rates and shrinking their balance sheets.
Shrinking a balance sheet sounds complex, but mechanically it just means the central bank is selling bonds and taking cash out of the financial system. They are literally wiping the grease away.
Yeah, that's a great way to put it.
The gears of the market might still turn for a while on pure momentum, but the friction is building under the surface.
The system becomes rigid. And when a financial system is rigid and highly leveraged, which we established in stage 1 and 2, it brings us to stage 5, the trigger.
The trigger is always the unpredictable spark. In 2008, it was the collapse of a specific major investment bank. Tomorrow, it could be an unexpected geopolitical conflict, a failure in the banking plumbing, or simply a terrible earnings report from one of those 5 mega-cap tech stocks we talked about in the concentration trap.
Right.
The trigger itself doesn't cause the crash. The trigger merely exposes the fragility that was built up during the first 4 stages.
So after outlining all these historical patterns and extreme valuations, what does this actually mean for the listener?
So what does this all mean for you? If you were listening to this and feeling a rising sense of panic, take a deep breath. In the Wealthnetic style, we don't operate on fear. We operate on preparation. We translate macroeconomic data into actionable steps to build resilience. You cannot control the economic weather, but you can absolutely build a stronger ship. Let's walk through 3 practical, actionable tips drawn from our sources today.
Tip 1, review your concentration. You need to look under the hood of your portfolio today. If you hold passive index funds or target date retirement funds, look at the actual breakdown of the holdings.
Yeah, you have to read the fine print.
You really do. You might assume your wealth is broadly protected across hundreds of different industries. But due to that market cap weighting we discussed, you might be dangerously overexposed to a handful of tech giants. Ensure your diversification is functional, not just an illusion. Diversification is really the only shield you have when a concentration trap snaps shut.
Tip 2 is about surviving the actual storm. Increase your liquid buffers. The sources strongly emphasize the importance of keeping enough cash or cash equivalents on hand to cover your near-term life needs, whether that is an emergency fund for a roof repair or living expenses in case of a job transition.
The mechanical reason behind this tip is vital. The absolute fastest way to permanently destroy your wealth is being forced to sell your investments at the bottom of a 30 to 50% market drawdown simply because you need to pay your monthly bills.
Right. Forced selling is the wealth killer.
Exactly. If you have a liquid buffer in cash, you can ride out the storm. You give your investments the time they need to recover. The goal is to be the person observing the market panic, not the person forced to participate in it.
Which leads perfectly into tip 3. Frame weakness as opportunity. One of the major investment banks cited in our sources specifically advises their clients to treat technical market weakness or temporary flash crashes caused by algorithmic selling as a buying opportunity.
This requires a major shift in market psychology, though.
It does.
If you have done your due diligence and you own equity in quality companies with strong fundamentals, low debt, and real cash flow, a market downturn is not a reason to panic. It is a rare chance to acquire more high-quality assets at a steep discount.
Like things going on sale.
Precisely. Historically, a market crash operates as a massive wealth transfer mechanism, moving capital from the impatient and over-leveraged to the patient and prepared.
To quickly recap our deep dive today, we are standing at a fascinating historical crossroads. Valuation metrics like the market cap to GDP and the Shiller-Cape-E ratio are stretching toward completely unprecedented territory.
Yep.
The AI boom is driving incredible, world-changing innovation, but it is simultaneously creating extreme market concentration and vulnerabilities through things like circular investment loops.
But by understanding the mechanics of how crashes unfold, from the buildup of margin debt to the slow draining of liquidity by central banks, and by respecting the mathematical reality of mean reversion, you realize you don't have to be a victim of the economic cycle.
Exactly.
Preparation allows you to navigate the extremes.
And preparation is the absolute foundation of the Wealthnetic mindset. If you found today's deep dive valuable, we invite you to subscribe to the Wealthnetic channel, share this deep dive with a friend, a colleague, or really anyone who's trying to make sense of this wild financial market. And please drop a comment below letting us know what topic we should deep dive into next. We build the show around your curiosity.
Before we sign off, there is one final lingering question I want to leave you to ponder as you review your own portfolio. We have spent this time discussing how assets eventually revert to the mean, how the leash eventually snaps the dog back to the owner.
Right.
But if artificial intelligence actually delivers on its ultimate promise to radically revolutionize global productivity, if it succeeds in curing diseases, autonomously writing complex code, and permanently automating massive industries, what if the old historical mean is truly gone forever? Are we all just driving ourselves crazy trying to measure tomorrow's economy with yesterday's ruler?
Wow. That is a phenomenal thought to end on. Until next time, stay curious, stay prepared, and we will see you on the next deep dive.